Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Sal Tarsia. He is the managing partner at Castle Green Finance, a premier provider of commercial property assessed clean energy financing solutions. Sal has 30 years of expertise in commercial real estate financing. He has built and led multiple lending platforms, originating and structuring billions of dollars in transactions across ground up construction, adaptive reuse, and large renovation projects. His career spans leadership roles at Hannon Armstrong Sustainable Real Estate, where he ran the principal transactions group, co-founding Bedrock Capital Associates, and serving as co-head of the lending operations at Capmark Refinance, where he managed a team of 22 professionals, originating over $15 billion in CMBS and structured debt. So, Sal, thank you so much for coming on the show today.
Charles, thank you very much for having me. It's a pleasure.
So you have a long history, background in finance. Can you tell us a little bit about what you did prior to getting involved in real estate and finance?
Yeah, I mean, I'm one of the few people I think that really knew what I wanted to do coming out of college. I attended NYU's Real Estate Institute and really jumped into real estate immediately after that. I spent a couple of years doing asset management and other kind of support roles in finance to really understand and learn what happens at the property level. But very quickly went into finance, which included commercial mortgage-backed securities or CMBS, as well as balance sheet lending and subordinate debt.
Interesting. So tell us a little bit about exactly what C-PACE financing is. As I spoke before, we haven't had anybody on the show with this specialization before.
Sure. CPACE is a public-private partnership that was specifically designed to incentivize owners as well as finance companies to put capital into projects to renovate them from an energy efficient standpoint. The programs really started from, as small as putting solar panels on roofs, replacing HVAC systems, and then grew to a point where it's very integral to ground up construction now.
Okay. Because I imagine you can be a lot more energy efficient with a new build versus renovating a value add property.
It can very often be easy to start with a clean sheet of paper and be able to put in those improvements from the start. But we also do a lot of older buildings, including some historic buildings. The program works very well with historic tax credits. Historic tax credits typically approach renovation and rehabilitation of properties more from an aesthetic and historic preservation standpoint. And PACE works very well with that because we take the same approach, but from the real guts of the project from an energy efficiency and equipment standpoint.
Interesting. So I've seen before some government programs before that give a discount for energy efficient. I know there was one, I think it was with Fannie or Freddie, that would give you a slight discount on your rate if you put in certain types of low flow type water facilities, products, whatever fixtures into your property. What are some of the benefits of C-PACE financing versus traditional financing?
So CPACE financing is very different in the public-private partnership arena in that we don't get the benefit of any government guarantees, and we also don't use any taxpayer money. What we benefit from is the local government. PACE, unlike a lot of programs that can be federally based, PACE is state based. So there's a state statute that is passed, and then individual communities, whether they be cities or counties, can opt into the state's program. And what it does, the government's role in this, is they take what looks to a traditional financier and property owner as a long-term fixed rate, self-amortizing financing product, and they take that fixed stream of payments and they record it as a special assessment real estate tax. So we get the benefit of having priority treatment in the capital stack, which allows us to provide lower rates than alternative financing methods for this type of product.
Yeah, the capital stack was exactly going to be my next question. So that's going to be something where I can take out maybe a preferred spot or a mezzanine spot, and I can just put senior debt, and then I can use this as part of it, and then our own in owner's equity. Is that correct?
That's absolutely correct, or like I like to refer to as the new improved capital stack. We basically flip the capital stack somewhat upside down from the financing or debt side of it, where we're very often a replacement for mezzanine and preferred equity, as you stated. In some cases, depending on the cooperation of the first mortgage lenders that we work with, we could also narrow the equity gap so that owners can keep a larger portion of their project or reduce the need for obviously much more expensive equity.
Now, how does this work with the lender? Every time that you start bringing on, I think with most lenders, subordinate debt or some sort of additional money, one way or another, on into the property to capitalize it, the senior debt is going to have some questions about this or a say in it, right? Because they don't want to fight a second person if they don't need to, if you foreclose or if you get behind on your debt. Can you tell us a little bit about how that lender usually acts when an investor brings this to them?
Yeah, absolutely. I got into the space a little over 9 years ago, and it was still very new. And like a lot of new programs, finance companies, can have an inherent fear of the unknown. And so we try to disarm that fear very quickly by indicating that we're just like a lot of other special assessments. If a local municipality does a sidewalk project or a water or sewer project in an area, it's been done for decades, if not close to a century. That they will do that project and then issue a special assessment back to the properties that benefit from that. PACE is very similar in that we're taking private capital, putting it into a single property, and issuing a very similar special assessment. So when we explain to the lenders that we work with that once we close, we have to behave in every way, shape, and form, just like a regular municipal real estate tax. We don't have any discretion. We can't really operate any differently. So it's something that the lenders are already accustomed to dealing with over their careers, and they can analyze it, and it's very predictable going forward for them.
So if it's like an assessment, how does that affect an investor that wants to exit the property, and how will that affect the buyer of that property?
That's an excellent question. So, unlike a lot of financial instruments, PACE does not have a due on sale clause. It also is a very long term instrument, typically 20 to 30 years in duration, that can be left in the project upon a refinance. And then, either the new owner or the new financial company coming in to do a new mortgage uh, can just analyze it the way that they would any other expense that might be in the property. So, think of it somewhat like a ground lease, except with a lot more flexibility, because we do provide the ability for a new owner or the existing owner upon a refinance. If, let's say rates drop by 200 basis points in the market, over a 4 or 5 year period, we do provide them with prepayment flexibility so that if there are alternative financing methods, or if they sell the property and the new owner does not want to assume the pace, they can pay it off.
All right. And how is that? How are you protected as in putting money into the property? Because obviously we know if senior debt, they're going to get first position on the property. They're also going to get paid probably the lowest interest rate on the property because of lower risk. How are you then protecting yourself if something goes downhill?
So that really is the key benefit of PACE, in that we're inserted into that real estate slot. So very similar to the way that municipal real estate tax works. If there is something that goes wrong with the property and the taxes aren't paid, then we can file a real estate tax lien against the property. It would abide by the same rules of that municipality, in that it'll follow the tax lien foreclosure rules that are prevalent in that area, which can very often be 2 to 3 years of notice cure redemption rights. That's the real benefit. That's what gets a lot of the first mortgage lenders comfortable, is that let's say we make a $10 million PACE loan. The entire $10 million isn't in front of them at any particular time. The only thing that is senior to the mortgage financing is the then outstanding payment. Once that payment has been brought current, then we go back into the corner and sit there in a very passive role and move on. However, the real estate tax lien rules are in place to make sure that while this isn't a gun to anybody's head, that it's not ignored as well.
That's a great position for you to be in because, as I've understood over the years, I mean, that is the banks will make sure no matter what happens at the property level with the owner of the property, that taxes and insurance will be paid. So that's a great position for your funds to be in. How does that work with like the time frame? So you said if you're sitting in a back seat, passive position after stuff is brought current, how long when you do financing like this, how long does that usually stay? I mean, how long are these kind of the term on these?
So the term is typically 20 to 30 years on a self-amortizing basis. More prevalent, and it depends on the interest rate environment. The current interest rate environment that we're in right now, we would expect that most borrowers are likely going to pay off the PACE in conjunction with some other permanent financing once they stabilize the property. If we're in a lower interest rate environment, the PACE can be very sticky and it can stick into the capital stack, possibly for the full term. On average, I would say the life of a PACE loan is typically going to be plus or minus 10 years.
I know you have a map on your website, which I forget the number of states, but it is pretty prevalent. This product is throughout the United States. Do you have a number? It was like 30 states or something like this that it is available in?
So there are currently 38 states that are in, plus Washington, D.C. acts as its own unique program. I think we can divulge this given the timing of this podcast. State of Vermont should be due to come online hopefully before the end of the month.
Oh,
So
wow.
that would
Okay.
make it 39.
Yeah, I saw that in the Northeast. There was New Hampshire and Vermont were the only two states there in the Northeast. I think were part of the program, if I remember correctly. I looked at it quickly, but it's great.
Yeah, New Hampshire is online now. Uh, yeah, and Vermont had a statute, but it was extremely flawed in its initial creation. It was structured more like mezzanine debt, which wouldn't make it particularly attractive. That's been amended, and we're very excited to get into that state.
Yeah, that's fantastic. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. There's another feature of the CPAS loan that I wasn't aware of, and it's called like the retroactive like look back feature. And I see this if someone did renovations years before, and now they can come back to you and they can get financing. How does that kind of work?
Yes, most states allow up to a 2 to 3 year look back. So let's say that somebody was unaware of the PACE program, or at a particular time they had different options or they needed to move quickly. They can do renovations, and any eligible improvements that were put into the project within that look back time frame can effectively be refinanced. And that could potentially pay down more expensive debt. It could potentially reimburse the borrower for equity contributions they made into the project. At that point, it becomes very fungible capital.
When the decision for CPAS, it's done on a state level, is it also done as do the municipalities have any kind of say in it or any control over it, or is it just state level that makes the decision?
State level makes the initial decision. Now, like with any other law, there's going to be, lobbyists and different interest groups within the state that typically speak up, which may include certain municipalities that have certain needs. But the municipalities' ultimate control is they're not obligated to be in the program. So once a state statute is passed, then it becomes a process of going city by city or county by county to see if they want to opt into the program. And that typically starts, like anything else, with the largest, most populous counties and cities, and then works down from there.
What would be some typical projects that people utilize CPACE financing for, or some projects that you've been involved with?
So hotel seems to be very popular within the programs. They have, a lot of PACE eligible improvements within those property types. Um, there also has historically, in more traditional financing, been significant constraints on hospitality financing, which leaves more of an opening for our program to step in and fill those gaps. But it can be used on virtually any type of building type. We do multifamily, we do senior living, retail, office, industrial. There are also certain esoteric projects. We recently closed a hotel with an adjoining amusement park and water park on it.
How is like the big beautiful bill impacted CPACE financing? I mean, they put so much stuff into these bills when they go through. You don't really know what's in it. They probably don't even know either. How has that impacted what you do?
Yeah, there's been some incentive because I think the biggest thing as it appeals to the PACE program is that a lot of the depreciation can really be front loaded, while at the same time PACE is a long term instrument, so they can utilize the depreciation while extending their financing out for a very long period of time.
When people are selling properties, let's say because they have this and this is now, it just goes in as an above the line type expense. Is that correct? Because it is now property taxes as an expense, not some debt servicing, correct?
That's correct. It really is a hybrid between a piece of debt and an expense. And when a new owner is coming into it, they can really choose to have the property delivered free and clear of the PACE, or they can elect, through their negotiation with the seller, to keep it in. And I'll give an example. There were projects that we did back in 2021 and early 22 that may have had coupons below 6% in an interest rate environment where 10-year treasuries are roughly 4.5% today. That can become quite an attractive piece of financing to be able to assume for a new buyer.
And that's how it's done. They're usually done when one of these projects or one of these financing products are utilized 20, 25 years, what you're saying before the term on them, it's going to be fixed. Is that correct?
That's correct. We fix the coupon; it never changes for the life of the PACE assessment.
Oh, that's great. What would you say, kind of as we're wrapping up here, what are some common mistakes you see developers or maybe value add investors make when they're trying to structure a deal involving CPACE?
The biggest mistake that we see is order of operations. We still see, and the market has gotten a lot better in this regard. The brokers who represent a lot of these owners for financing have really learned the proper way to go about it. We would advise any developer or redeveloper to come to us first. Because of our position in the capital stack, when a package goes out to a first mortgage lender, they never want to do all of their work, issue a term sheet, and then have somebody say, "Oh, wait, I'm sorry, I forgot to tell you, I want to use PACE in this capital stack as well." They're much better off getting a proposal from us first. They can build it into their projections and their pro formas and then deliver it to the lenders out there who, A, are receptive and understanding of PACE, and B, now have knowledge so that they can do their initial underwriting correctly with the full knowledge of what's actually there.
That's great. One of the things is, as kind of a wrapping up here, I like to always ask, when at your professional level over your career, what do you think you have done that has really compounded the most for you?
You know, my passion in real estate has always been structuring, really figuring out complex situations. That's what really led me to the CPACE world. I spent a lot of my time in real estate doing complicated structures that went onto balance sheets or were subordinate debt. However, when you do those types of projects, you always have to be front and center on what's the risk profile I'm taking on. Because of where we're placed in the capital stack, uh, not that risk profile is ignored, but because we're in such a safe position, it now becomes secondary, which allows myself and my team to really focus on what can we do to really make this project beneficial for the owners? How can we make this appealing to the financial partners that work with us on these deals, as opposed to everything being really surrounded by the risk? The risk profile is going to be transferred more to the first mortgage lender from a concern basis. And we try to work with them to structure the deals properly, to relieve that, to make them comfortable. Um, we've always really tried to package PACE in a way that owners, developers, GCs, and even our financial partners, what they're already accustomed to doing, rather than trying to form fit them into a PACE box, if you will.
Sal, how can our listeners learn more about you and Castle Green?
We have we're very active in posting up the deals that we do. They can go to our website as well, www.castlegreenfinance.com. Our website is designed as much for education as it is for marketing purposes. But quite honestly, I might be a little old school in this regard. I'm still a big believer that picking up the phone and having a conversation is really the best way to learn what we can do and how we can benefit their projects.
Okay, great. So what I'll do is I'll put that link into the show notes. And thank you so much for coming on today.
Great, real pleasure, Charles, and really enjoyed working with you.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.